Welcome to the first edition of Get Wealthy, Stay Wealthy from Lansing Street Advisors. I'm Matt Topley. We had one of the most interesting months we had in quite a while. As usual, the media headlines were all end of the world. War, inflation, recession, war, inflation, recession. They couldn't get enough of it. Unfortunately, that drives investors to extreme fear. This is the CNN Fear and Greed Index, and it hit extreme levels of fear. Now, investing is a psychology game, not an IQ game, and that is when we start letting our emotions drive our investment decisions. This chart's telling us that investors unfortunately piled in the cash, in some instances selling stocks, piling in the cash, right when extreme fear was at its highest and the media headlines were end of the world. Unfortunately, war is not negative for the economy or the stock market. The market is amoral. The market is driven by earnings and profit margins, not by headlines. This chart goes all the way back to World War II, the blue squiggly line slowly moving higher, $1 to $12,000, through all the wars that have happened in modern times. But a much more important chart, let's just shrink it to 9/11 until today. So 9/11, war in Afghanistan, war in Iraq, COVID, some people refer to as a war, 2 invasions of the Ukraine, and then multiple wars in the Middle East. From 9/11 to the end of a week ago, the total return on the S&P 500 is 708%. I want to repeat that. From 9/11 till now, invasion of Afghanistan, war in Iraq, 2008 financial crisis, COVID, multiple wars recently in the Middle East, the market's up 708%. Please teach this to your children and grandchildren. This time around, we smashed the leadership and favorite stocks in the market, the Mag 7, all the household names that retail investors have been buying for 15, 20 years. All of them had huge drawdowns from their 50-week highs. They had such massive drawdowns that they became, based on forward price to earnings ratio, which is just a measure of how expensive or cheap a stock is, they became equal to consumer staples, the most conservative group in the S&P 500 in valuation. What does that mean in plain language? It costs you the same amount to buy Google, Apple, Facebook, etc. as Coca-Cola, Pepsi, Procter & Gamble, things you see at the supermarket. As I mentioned earlier in this short video, the market's really driven by profit margins and earnings, and as this chart's telling us that margins, from Carson, is telling us that margins are at all-time highs, and that is before AI has truly kicked in and driven down costs and increased margins. And one of the favorite measures, especially from tech companies today, is revenue per employee. So simple measure, if you have 10 employees in the firm, of course it's better if you have higher revenues per employee, not lower. And revenue per employee is breaking out to all-time highs before AI has kicked in and really lowered costs. So the moral of the story is the same thing that has gone on since the beginning of time in the stock market. Missing the best days in the market is a colossal mistake. And here is performance of $10,000 from January 2nd, 2006 to December 2025. 11% return in the S&P 500. Your 10,000 grows to 80,000. If you miss the 10 best days, you almost see your return cut in half. Unfortunately, historically in the stock market, these best days happen in high volatility market situations like we've had in the last month in the market. Okay, that's it. Remember, investing is a psychology game, not an IQ game. Please control your emotions.